Hi, everyone. I'm Kieran O'Dwyer, Vice President of Corporate Communications at Mutual of America Financial Group. Thank you for joining our mid-year economic and market perspective webinar. Just a quick housekeeping note. We will display a QR code at the end of the webinar for you to download the slides. You can also access related content through the paperclip icon on the webinar during the presentation. Today's webinar focuses on the performance of the financial markets during the first half of 2023 and looking ahead, and importantly, on inflation's continuing impact on the markets, economy, and consumers. Inflation is well down from its high of 9% last summer, but Americans continue to feel its effect on various fronts, with food and gas prices, home mortgage interest rates, and retirement savings accounts, just to name a few. To combat this, since March of 2022, the U.S. Federal Reserve has aggressively raised interest rates in its attempt to cool the economy, reduce inflation, and avoid a recession. As always, to provide expert insights and analysis, please join me in welcoming Stephen Rich, Chairman and CEO of Mutual of America Capital Management, LLC. Thanks for joining us again, Stephen.
Yes, of course, Karen, and it's great to be here and want to share our thoughts about the market.
Great. As we've done in the past, Stephen, why don't we start by looking at the financial markets? The inflation numbers continue to decline from their peak last June, as I mentioned at the top, but consumers are still feeling the impact. And yet on the bright side, the markets, and in particular the equity markets, really continue to perform well overall in the first half. Can you give us a characterization of some of the nuances that have occurred in the markets in the first half of the year to allow this to happen?
Yes, of course. So if we look at this first chart, we can see that the equity markets across the board have been quite strong during the first half of the year. This is a reversal from what we saw last year, especially in the first half of the year. In general, growth has outperformed value. As you can see, the NASDAQ index and the Russell 1000 Growth Index are the most positive during this period. We've also witnessed that the mega cap growth stocks have really driven returns. It's what we call a very narrow market. In fact, if you look at Amazon, Apple, Google, Meta, Microsoft, Netflix, NVIDIA, and Tesla, these are all up 59% for the first 6 months of the year, while the rest of the S&P is up a mere 3.7%. It's also been the best first half for the NASDAQ index since 1983. And as I referenced before, growth is outperforming value by almost 24 percentage points. One other amazing thing that I think has happened over the course of the last almost 18 months is if you go back to March 17th of 2022, in the face of 5% interest rate raises by the Federal Reserve, we actually find that both or all the S&P, Dow, and NASDAQ are up all about 3%. And so I think that's pretty resilient in terms of the stock market, how well those markets have done, even in the face of rising interest rates.
It's pretty amazing what you just described about those 8 stocks really driving the performance of the market, and these mega cap stocks and how dominant they are, and really have been for quite some time. I just want to ask you, what has that done to the composition of the index? And also, what are the risks of such a composition and implications for that for the index?
Yeah, that's a great question. And we've constructed a chart which really shows what has happened to in this case, we're looking at the 5 largest stocks in the S&P over multiple decades here. And we can see that where we stand today is that the S&P is very concentrated with 24% of the weight being made up of the top 5 stocks, which would indicate that on average, each of those stocks is 10%, or excuse me, 5%. However, if we go back in time, when the concentration was closer to 10%, that would mean that each individual stock would be approximately 2 percentage points. So the concentration of these large stocks is really driving the market. And so if any of these stocks were to falter or go down, it would have a meaningful influence on the overall index. Another way to put this in perspective is these top 5 stocks have a forward multiple, price to earnings multiple of 36%. That's versus the rest of the market, or the broad market, I should say, at 18.9. So these stocks have experienced multiple expansion well beyond the other constituents in the index, and in fact look relatively overvalued versus the rest of the S&P 500.
So those are great insights as it relates to the mega cap stocks, and really helpful to see that information. I want to just shift gears for a minute and talk a little bit about the implications for the small cap market, which has really underperformed compared to the larger caps for some time. And in thinking about that, when might you see a rebound, or when might a rebound occur for small cap companies and the market begin to broaden back out?
All right, so we put together this chart, and it's reflecting a similar theme here, which is that large cap stocks have been doing much better than the smaller cap. In the prior slide, we talked about mega cap stocks versus the rest of the market, but this is a similar phenomenon. And what we've seen over time is that there has been a cyclical relationship where small cap stocks have been larger percentages than they are currently, which they stand at about 6%, which is very close to all-time lows. We would expect small cap stocks to do relatively better than large cap stocks once the market starts to broaden out. We believe that the market will start to broaden out as we go through a more dynamic upturn in the economy, and that may come after a slowdown or even after a recession. So we actually believe that as the market broadens out, the small cap stock should be a beneficiary and should rise as a percentage within the overall index. Another point that I'd like to make here, we talked about mega cap stocks before, is that the market capitalization of Apple is actually the same as the market capitalization of the whole Russell 2000 at this point in time. So you can see how dominant at least Apple is relative to the rest of the market.
Yeah, I'd say that's putting it mildly. You talked a fair amount just now about some of these companies as they relate to equities and bonds and so forth. But let's take a look at corporate earnings for a minute. What's going on with the underlying fundamentals for earnings of companies? Is there a slowdown? Is there a slowdown happening here?
Yes, Kieran, there is a slowdown that's happening with the fundamentals of the underlying companies. And we've measured this. Estimates for the second quarter of earnings, which are occurring now, are actually for negative 7.5%. And if we look out to the third quarter, the estimates are for flat or positive 0.2%. So earnings are decelerating. And we've also seen that profit margins have been declining for 7 consecutive quarters. Now, the relationship here is that actually revenue has been quite strong for companies. However, costs have risen because of inflation in both wages and raw materials. As a result, profit margins have been getting squeezed, and ultimately, as companies earn less, their valuations have been going up because multiples have expanded. And we believe that this is a little bit of an anomaly, that you've got earnings going down, but yet stock markets continue to go higher.
Thanks, Stephen. So, I'd like to just shift gears here a little bit and now look at the bond market. You've given good insights on equities. Let's talk about the bond market, which has been more volatile than stocks in general, but they're still producing modest returns. Take us through what's happening there. And also, while their numbers may pale in comparison to equities, we all know you shouldn't chase performance. So, regardless of the returns, bonds should be an important consideration for a balanced portfolio.
Yeah, that's correct. The bond market has had positive results on a year-to-date basis. However, most of these gains actually came in the first quarter when rates have come down. We've also seen that bonds have actually been a lot more volatile than stocks. So there's been a lot more back and forth as Federal Reserve has become more hawkish, less hawkish. More data has come out. So there's been a lot more volatility in the bond market. But yeah, it is very good for both bonds and stocks to go higher. And this is one of the reasons why the traditional 60-40 portfolio that had one of its worst years last year has done quite well this year. And this is a typical portfolio. It's a diversified portfolio and one that we would generally steer people in that direction. So it's good to see that both stocks and bonds have put up positive returns this year.
Now, since last year, we've heard increasingly, and you hear it a lot more in the news about the yield curve. So much so that it's not just being talked about in financial and economic circles, but really in the general news cycle. Can you take a minute just to give a big picture view of the yield curve, what it is, why it could be problematic, and may signal an economic downturn or slowdown?
Yes, an inverted yield curve is when short-term rates are higher than long-term rates. So seen here in the graph, we can see that the 3-month Treasury actually yields 5.37, while the 10-year Treasury yields 3.81%. The yield curve has been inverted since last year. In general, an inverted yield curve is based on how investors perceive the trajectory of the economy. If investors believe that there's an upcoming slowdown or recession, they flock to longer-term bonds. And this is exactly what we've seen this year, that at least in the bond market's perspective, they are anticipating somewhat of a slowdown. What I do know is a yield curve can't stay inverted forever. It's very difficult, especially for financial companies that borrow at short-term rates and lend at long-term rates. When short-term rates are higher than long, this becomes a very difficult environment. And I think that's some of the things that affected the selected financial companies earlier in this year was their issues dealing with the inverted yield curve. Now, an inverted yield curve doesn't mean that a recession is happening, but there is a very high correlation between an inverted yield curve and a recession. And in fact, an inverted yield curve has preceded the last 10 recessions. So this is sort of a signal that's flashing that at least the bond market believes that the economy should be slowing as we move forward through this year and potentially next year. And so it's a gauge certainly to keep our eye on.
Thanks for the insights there. And I think that's really a great segue into having a little discussion about inflation at this point. It's the elephant in the room and has been for the last 16 months or more. And the numbers, though, show significant easing since it peaked above 9% last summer. So if you could take us through the CPI, which includes food and energy, and then maybe go through some of the other government inflation gauges and what's happening there.
Yes, inflation is certainly front and center, and it has been for quite some time. If we look at this chart, we're looking at the inflation rate, the headline CPI going back to 2012. we can see that inflation has started to cool. The most recent reading at 3%. However, that's still above the Fed's target of 2%. But we have seen it come down from its peak, as you can see in June 2022. Inflation peaked at 9%, 9.1. So in fact, CPI has come down by almost 6 percentage points. There are some other gauges that the Fed looks at in terms of inflation and monitoring inflation. And so we've already talked about CPI. As you can see, CPI on the right-hand side of this chart is now at 3%. However, if you go back to December, it was 6.5. So once again, we've seen some modest contraction in that over the course of the year. You can also see the same picture with the PPI number, which in December was 6.2 and is now basically flat. And then if we turn to the PCE, which is the Fed's preferred gauge of inflation, this is a broader survey than the CPI. We've seen a little less improvement here. The PCE was 5 percentage points at the end of December, and now it's down to 4.6. So this has proven to be a little bit more sticky. And so if we're looking specifically at the PCE, I would say that the Fed's probably got a little bit more work to do in terms of curbing inflation.
Yeah, there's definitely a lot of great numbers there and a lot of data. As we think about what that means in the big picture to things like food and gas and energy and commodities and so forth, we just looked at the CPI. You showed us and talked us through those indices. What are some of the reasons, and would you give a few examples where those have fallen short on a year-over-year basis?
Right. So the next couple of slides, I think we'll talk to that, and you'll also start to see why the CPI has moderated over the course of the last year. So the first one we're going to look at is the select food categories, and what we've put here on the chart is from a year ago. In the blue bars is where each of these categories stood, which were very elevated, and then in the orange bar where they stand today. And the takeaway here is that they're not as high as they were a year ago. They have come down, but they are still elevated. So I think that's one of the reasons, and I think that tells a lot about the underlying CPI. The next chart is one of my favorites, and it's gasoline prices, and gasoline affects consumers almost every day. I think we see really the same picture here, that prices are off their peak. If you recall, gas prices peaked last June at over $5 a gallon. They've moderated earlier in the year to about $3.20, and they've ticked up a little bit, I think more of a seasonal uptick than anything else, and are here at about 3.36. And so once again, the prices have come off the peak, but I think they still remain pretty high relative to where they've been historically. And the final slide is on commodities. And we can see once again that commodities have come off their peak. This is especially true for base metals such as copper, aluminum, and iron. Gold has really been the only bright spot in that complex. And you can see that the index is off 26% since its peak last year. So as we look at food, we look at energy, we look at commodities, these elements have all come down from their highs of last year, but they still remain elevated. And so these, once again, feed into CPI and these other inflation gauges. So perhaps there's a little bit more work that needs to be done by the Fed.
Yeah, talk about segues. I mean, that's a great one in terms of it seems everybody is paying close attention to and really parsing every statement by the Federal Reserve lately. Uh, we know they took a pause from raising interest rates. They took a pause in June, but since last March, they've been on this continuous aggressive stance on raising interest rates to cool inflation. Can you take us through what the Fed's next steps might be to help cool the economy and get inflation back to that target rate of 2%?
Yeah, let's just recap what's gone on here. So if we go back to March of 2022. That's the first time the Fed has raised rates. They've raised rates 10 times since then. And as you suggested, in June, they maintained, or I think the term widely used is they paused during the most recent meeting, wanting to see more data or be more data dependent as we move through the balance of this year. However, markets are currently pricing in a 92% chance that the Fed will raise rates by 25 basis points at their next meeting in July. The market is also pricing in a 26% chance that there'll be another raise of 25 basis points in the September meeting. What's probably more important, and perhaps where the market is a little bit out of sync with what the Fed has been communicating, is that the central bank also does not expect to take rates below 5% until next year. So I think there's a lot of anticipation in the market that, or maybe hope, that the Fed will begin lowering rates soon or pause. However, given the factors that we've talked about already, that things like PCE remain at least twice as high as their stated goal, it would appear to me that there's more work to be done, and I certainly would not be surprised if they raise rates another 2 times in this year.
So with that in mind, Stephen, even as the Fed has taken aggressive actions over this, since last March, as you mentioned, interestingly enough, it's no secret that unemployment rates in the U.S. have really remained at near historic lows. And also the job market and employee wages, they've been consistently strong. So how long can this be sustained and still enable the Fed to make a soft landing, to do its job to get inflation contained?
Yeah, labor has been a real thorn in the side of the Federal Reserve. As we've mentioned throughout this presentation, a lot of work has been done and a lot of positive things have been put into the market to slow the economy, but non-farm payrolls still remain pretty high. In June alone, there were 200,000 new jobs. This is still well above historic averages. Historical averages are about 125,000. As you mentioned, unemployment continues to be at or near historic lows. And certainly one of the characteristics of virtually every recession we've had is that the unemployment rate goes higher, and that's not been the case. Another area where I think the Fed continues to be concerned is in the average hourly wages, which are running at about 4.5%. This is a component that gets into CPI, gets into PCE, and if this number continues to run in this 4% range, it's going to be difficult for the Fed to lower inflation meaningfully from where we are. And another reason why hourly wages continue to be strong is because there are almost 10 million job openings nationwide. So when there's an imbalance of supply and demand, that's going to keep wages pretty strong and sticky. And that tends to be, very hard to take out of the economy to lower wages for people. So as I said, there's a lot more work to be done. If you look at the labor markets, you really don't see that there's a recession on the horizon. And that's one of the things that we're seeing a lot of data indicating slowing, but yet labor continues to be very strong and bucking that trend of slowing.
Yeah, and obviously Americans in general are trying to make sense of what's happening in the financial markets and with the economy. So much of what you discussed today, with all of that in mind, and how these issues are going to affect their savings and spending. What should individuals be on the watch for in the coming months?
Yeah, as an outlook, I would say that the Federal Reserve is going to continue to manage interest rates to slow the economy. They need to tame inflation, and they'd like to avoid a recession and create a soft landing. We'll have to see whether or not they can accomplish that. We haven't seen too many soft landings historically as the Fed toggles or changes interest rates. As a result of that, I believe that financial markets will continue to be volatile in 2023. I also believe that the volatility is somewhat of a function of people reacting to short-term data and policy makers' comments that drive markets in one way one day and drive them another day. And as we suggested, labor markets and wages continue to remain strong, and they really are the headwind in terms of bringing down inflation as we move forward through the balance of the year. So we've gotten off to a really strong start in terms of the equity markets and the fixed income markets. Would anticipate that the markets or the economy starts to slow, and we'll have to see how the balance of the year plays out in terms of where the markets ultimately end up.
Well, great. We'll definitely be keeping an eye out on it, and want to thank you again for walking us through all of this important information and topics, Stephen. Thank you.
Happy to do it, and I look forward to speaking to you again in the future.
Great. As always, also thank you for taking the time to watch the webinar today. And as I said at the top of this presentation, you can use the QR code to download the slides from today's presentation. Also, related content is available through the paperclip icon on the screen. And this webinar is available at mutualofamerica.com to watch and download at your convenience. So finally, please take 1 minute, if you would, to complete a brief survey. And thanks again for watching, and have a great day.